Good afternoon and welcome to our class. Right, remember that this one is going to be quite a long class, as we'll be finishing around 5. Then tomorrow we have another class again. I think just check the charts on the timing. I wanted to try to finish financial instruments today so that tomorrow we do employee benefits. Right, so that by Tuesday we're doing consolidation. Right, I think before the test we won't have time to do an overall go through. So please make sure that you are also going through the old work that we have done. Things like PPE, I think you saw that they were not in the last tests. I highly expect them to come in this forthcoming test. So please revisit those things so that you are fine with them. All right. We'll proceed. Right, before I move on to financial liabilities, I would like to talk about uncollectability and impairment of financial assets. Right, sometimes it happens that there is a possibility that financial assets can be impaired. If you have an asset, economic conditions can go bad to an extent that you might lose. You might not be able to receive money from the financial instruments. For example, if you sell on credit, it's possible that your debtors may fail to pay you. If you buy debentures, the company where you bought debentures may suffer and they may fail to pay you your interest or the principal amount. If you buy shares, the company can liquidate. So there's always a possibility that your financial instrument may lose value. Right, so we have to take into account for that allowance for credit losses that may expected credit losses. So now I want to look at examples that include such credit losses. Right. So an allowance for credit losses should be recognized where applicable for the following categories: financial assets at amortized cost and financial assets at fair value through OCI. Now you can see that one of the 3 categories here is not given. So we want recognize these expected credit losses for financial assets held through P&L, not for financial assets held through P&L. Right. At initial recognition, that is the day that you buy the asset, and at every year end that you are still holding the financial assets, you have to assess the credit risk associated with your financial instrument. You have to assess if you'll be able to receive your money from the financial instrument. Right, this risk is categorized in different stages. Right, we have what we call stage 1. When we say stage 1, credit risk is not increased significantly. So we're saying it's just the normal risk that is usually associated with credit. There's nothing extraordinary about that risk. Then stage 2, a credit risk is increased significantly. There is no objective of being credit. Right. Then number 3, there is objective evidence that a financial asset is credit impaired. Number 2, it's subjective. We're saying it's likely it's subjective, but number 3 now is objective. That means there is evidence, proper evidence, and solid evidence that your financial instrument has been impaired. For example, there's been communication from the liquidator about the amount that is likely to be received. There's an announcement of liquidation. That becomes objective evidence. Just a minute. Right. For trade receivables, the company can use the simplified approach, whereby they will not do detailed risk assessment. That is for debtors that are for trade. So the entity can then recognize lifetime expected credit losses at each reporting date. Right. When we talk about 12-month credit losses, we mean these are expected losses within the next 12 months. And lifetime expected losses, these are expected credit losses over the useful life of the asset. Right. When we buy a financial instrument on day one, we measure the asset at the 12-month expected credit losses. Then at each year end, it will depend on whether it's on stage 1 or stage 2. Stage 1, there is no increase in the credit risk. Then we use the 12-month expected credit losses. Then if risk has increased, but we don't have objective evidence, then we use the lifetime expected credit losses. When we say lifetime, 12 months, it's over the next 12 months. Lifetime is the losses over the useful life of the financial instrument. We don't, if you can see there, I ignored stage 3. Why did I ignore stage 3? Because in this syllabus, we don't deal with stage 3. We don't deal with stage 3. That's why you see that I've left stage 3 there. Right. So now I want to show you what we mean with what I've just said. By looking at, we want to look at question, I think we did question 1. Want to look at question 2. At question 3, we did it. And question 2 and probably question I think we'll deal also with question, for now, we'll deal with question 2 and question 9. Right, let's go to question 2. Right. Capital Investors Limited is a hedge fund company based in Johannesburg with a 31 December year end. Capital Limited purchased 1,000 10% redeemable debentures for 100,000 on 1 January 2020 and incurred 2,000 transaction costs that were directly attributable to the acquisition of the debentures. The debentures are redeemable on 31 December 2021 at 120,000. It is the intention of Capital Investors Limited to collect annual contractual cash flows of principal and interest from the investment with no intention to trade. The fair value of the investment on 1 January 2020 and 31 December 2020 was 100,000 and 115,000 respectively. The debentures were not considered to be credit impaired at any stage on 31 December 2020. The expected credit loss information for the investment in redeemable debentures was as follows. The bookkeeper had processed the following journal entries to account for the redeemable debentures in the accounting records of
Right, done.
Hello?
Yes, sir.
I think that's a private conversation. Sorry for that. Right. The bookkeeper had processed the following journal entries to account for the redeemable debentures in the accounting records of capital investors. Right. When you meet such a question, you have to know, are we the ones buying the debentures or we are the ones issuing the debentures? So in this case, you can see we are the ones buying the debentures. We are capital investors. They purchase the debentures. Now, because they purchased the debentures, that means this is a financial asset to us. If we're the ones issuing, it could have been a financial liability, right? So now the question is, discuss the accuracy of the journal entries provided by the bookkeeper to account for the investment in debentures in the accounting records of capital investors for the year ended 31 December 2020. Your discussion should include reasons for errors identified and should provide recommendations on how to correctly account for the investment in debentures for the financial year in terms of IFRS 9. Your discussion should be supported by relevant amounts and calculations. Ignore taxation. Right. First of all, I want you to follow my argument here. Right. Right. The purchase of the debentures results in a financial asset in the hands of capital investors Ltd. There is the contractual right to receive interest annually from 31 December 2020 to 31 December 2021 and receive the principal amount on 31 December 2021. The purchase also results in a financial liability in the hands of the issuer. Right. Resulting in a contractual obligation deliver cash in the form of interest annually and the principal. Right. So in the hands of capital investors, this is a financial asset. And in the issuer's hands, it's a financial liabilities. Therefore, right, we can say considering that it is a financial asset to one part, capital investors, and a capital a financial liability. Another part. Therefore, this is a financial instrument. To be accounted for in terms of IFRS 9 or IAS 32 there. So here I was just trying to show that to show the direction that we're going to use to account for this. Right. Then the second thing, now we know that it's a financial instrument. Right. This financial instrument is a financial asset in the books of capital investors. I don't have to mention why again, because I've already mentioned that above. I've already mentioned that this is a financial asset above there. So I don't have to go back and explain again why am I saying that. Right. Then now, why am I mentioning all this? Because how it should be accounted for would depend on whether it's a financial asset, financial liability. So, right, financial assets are classified and subsequently measured on the basis of the entity's business model. For managing such assets. And the contractual characteristics of the financial assets. All right, a financial asset, remember what I said in the previous class. First of all, we have to test if it can be classified at amortized cost. Right. A financial asset is measured at amortized cost if both of the following are met. And let me just take above so that I don't waste time. I think we did something like this. This one's there, these conditions. Right. So the asset is held with a business model whose objective is to hold is to hold the asset in order to collect contractual cash flows. Right now, according to the question, it is the intention of Capital Limited to collect annual contractual cash flows of principal and interest from the investment with no intention to trade. So that that first requirement is met. So I saying the first condition is met considering that Capital Investors Limited hold the debentures within a business model whose objective is to collect future contractual cash flows. Right. Then the contractual terms should give rise on specified debts to cash flows that are in principal and interest. And I explained here that there will be interest from 31 December. Right. So here, Capital Investors Limited will be entitled to payments that are solely interest every 31 December from 31 December 2020 to 31 December 2021. And the principal on 31 December 2021. Therefore, the second condition is also met. So I'm saying the debentures should be classified as a financial asset at amortized cost. That's number one thing. All right. Why did I dwell on this classification? Because it is the one that will determine how we shall account for the financial asset. That's why I had to do this. Right. Now, we know from this table. Sorry, I think it's not on this sheet. Yeah. That initially, if a financial asset is measured at amortized cost, initially, it should be measured at fair value, including transaction cost. Now, this bookkeeper did not include the transaction cost in the financial instrument. The transaction costs, as you can see, were recorded separately in P&L. We only do this if the financial asset is measured through profit or loss. So it was wrong to do that. So on 1 January, it was wrong not to include the transaction cost in the investment. So we're going to say if a financial asset is measured at amortized cost, the financial asset will be initially measured at cost, including transaction costs. Right, now there are two things that are wrong with this journal entry. I can say three. Number one, the investment is an asset. When you acquire an asset, you are supposed to debit it. So they were supposed to debit the investment 800,000, which is correct. 800 plus, not 100, 800 plus plus 2,000, which is 102. And they were supposed to credit bank 802,000. So we can say the bank was wrongly debited Or maybe let me just do this. Let me do this. I want you to follow my work when you are alone. Right. The bank was wrongly credited, debited, instead of credited. Remember, when you use money to buy, your asset bank is going down. So the bank should be credited. So it was wrong to debit. Your bank account is debited if you are receiving money. And a wrong amount of 98,000 was used instead of 102,000. Right. Then the investment in debentures was wrongly credited as acquisitions of assets should be debited. And should include transaction costs. Resulting in an amount of right. The transaction costs were wrongly separately recognized. Right. So our correct journal entry was supposed to be investment in debentures. One or 2,000. I will not be doing narrations for the sake of time. This was what was supposed to happen. As long as a financial asset is at amortized cost or at a fair value through other comprehensive income, the transaction cost should not be recorded separately. The transaction cost will be part of the investment. Any questions? Right. Then, according to IFRS, when you acquire these financial instruments, if credit risk has not been at initial recognition, we shall recognize what we call day one credit losses. And these day one credit losses should be recognized at the 12-month credit losses. And on 1 January, the 12-month credit losses were at 0%. So it was correct not to recognize day one credit losses because they were 0%. Right. So we were saying it was correct that day one credit losses were not recognized as the 12-month probability of default was 0% on initial recognition. But if there was a percentage there, we're going to recognize the day one credit losses. Right. Then subsequently, the financial asset shall be measured at amortized cost. And effective interest and impairment losses will be recognized in profit or loss. Right. Now you can see that this guy subsequently he then recorded fair value gain through OCI, which was wrong. So it was wrong to recognize fair value gains as the financial asset is not classified at fair value. Right. So that means first we have to do our amortization table. Which will start right. First of all, let's calculate our effective interest. Our PV is equal to negative 102,000. Remember, when we are classifying it amortized cost, our PV is cost plus transaction cost. Let me just remind you so that we are alone fair value plus transaction cost. Right. Then our PMT would be equal to our coupon here. We have 10% of 100,000. FV. So here is the coupon interest payment. Calculated on book or par value. Right. Our assumption in this case is that the book or par value is the same as our fair value, which is the 100,000, which does not include our transaction cost, considering that they didn't tell us the par value there. All right, so you don't include the transaction cost in calculating the PMT. FV is equal to 120,000. Amount to be received on redemption. Let me just show you so that we can follow all of us. Right. We are told that the debentures are redeemable on 31 December at 120. Then our N from January 2020 to 31 December 2021 is 3 years. The whole of 2020, so it's 2 years, sorry. The whole of 2020 and 2021. So our N is equal to 2. So then our I, what would be our I there? Can you give me to about 4 decimal places?
17.9025.
Thank you. Right. So then we'll have our amortization table here. We have our debts, coupon payments at 10%, effective interest at 17.9025. Capital growth. This time there's no capital repayment, there's capital growth. Why? Because our FV is more than the PV. So our principal will grow from 102 to 120. Then we'll have our balance. Right. So we have 1 January 2020, 31 December 2020, 31 December 2021. Right. We're going to start with 102,000. Right. Our coupon payment does not change. It's 10,000. Our effective interest, you can get it from your financial calculator. And remember, I told you that if you've got any challenges with the financial calculator, feel free to contact me. I think some have already contacted me, and I hope you are sorted now. Right, so this is our amortization table. Right, so the correct so now you would see that this guy, we said number one, I said it was wrong to recognize that fair value gain. Number two, it was wrong. The interest was supposed to be recognized using the effective interest method. So I was saying interest was supposed to be recognized using the effective interest method. So that means the correct journal entry on 31 December was supposed to be bank 10,000. This is SFP. I think when I did my previous journal, I didn't set here that it was SFP. We're now receiving money now. Right. Then, since our investment is growing, we're supposed to recognize and capital growth. Was not recognized. And unlike our previous example, whereby there was the principal repayment, now this one, our investment is growing. So there will be what? So you should check the differences between this one and the number, was it number 2 or this one here? There was a repayment here because our PV was less than the FV. So our investment were actually crediting it because there was a repayment of the investment. But in this case, our PV is less than the FV, so there's capital growth. Our investment will actually be growing, so we'll be debiting. When an asset grows, we debit it. When an asset increases, so investment in debentures is this one. Then we credit our finance income. So it's important for you to check whether there's capital growth or capital repayment. So in this case, we're saying our interest effectively is 18. Part of it is coming through the actual interest, effective interest. Then part of it is coming through the capital growth. So this is what was supposed to be done. Right. Then you'll find that this guy then determined the expected credit losses, which is correct. Right. Use the 4%, which is this one here. Lifetime expected credit losses. Right. The risk is still at level 1 because the debentures were not considered to be credit impaired. Right. So considering that the debentures were not considered credit impaired at any stage. The expected credit losses should be measured at the 12-month expected credit losses. As risk is at stage 1 and not the lifetime credit losses. But if they said that the credit risk was considered to have increased significantly, then we're going to use the lifetime. So it was wrong to use the 12-month, the lifetime. They were supposed to use the lifetime. So we're supposed to use this to calculate our credit losses. So whenever the credit risk has not increased, use the 12-month credit losses. But if they said it had significantly increased, use the lifetime. And this percentage, you apply it on your balance on that date, 31 December 2020. So we'd say we debit our expected credit losses, which is an expense, which is P&L. That will be our balance on 31 December 2021, which is 110,261, multiplied by 3%, the expected credit losses. What do we get? I'm waiting for you guys.
Okay, 3,308 rand.
Right. Thank you so much. Then we credit allowance for expected credit losses. So that's our suggested solution. Any questions? No questions. Right. If so, that's all on this one because they just wanted 2020. If you were going to 2021, again in 2021, I will not do the general entry, guys. We will then do this one based on these figures here on 2021. Then also the repayment of the 120. Remember, on 31 December 2020, there will be the repayment. The repayment, you just do it the same way here that we did here. This one here. I think, was it on question 1? I think I didn't do it. You just debit the bank and credit the investment. Then that's it. Right. Then I think I did it here. It was here. I know I did it. Yeah. You debit your bank and credit the investment at the end with the 120,000. Then there will be no credit losses to be recognized anyway on 31 December. Because remember, we are now liquidating the fund. Actually, the allowance, if we receive the full 120, we'll then have to do a reversal of this one. Right. Any questions? There are no questions. I'll move on to question 9.
Eugene, can you please change that question to question 2? Because I think it's going to confuse people. You said it's question 3. The one that we just did now.
I think I did. I wrote question 2 if I'm not mistaken.
Yeah, please change it to question 2.
I think I wrote question 2. Or I wrote 3. Thank you. Right. Number A, discuss in terms of IFRS 9 financial instruments whether you agree with Investco Limited's Chief Financial Officer's opinion regarding the classification and measurement of the debentures, investment in debentures. I will be very fast on this one because I think I've done a lot on this. So we're told that Investco Limited is a company that sells paper magazines and online magazines and is a 31 December financial year end. Investco Limited, investment in Tego Limited debentures. Remember, we're Investco. Right, on 1 January 2018, Investco Limited purchased 10,000 12% debentures in Teco Limited at their fair value of 550 per debenture. The coupon interest on the debentures is payable on the 31st of December each year. The debentures were originally issued by Teco Limited on 1 January at their face value of 600 each. The principal amount is mandatorily redeemable on 31 December 2022 at face value, and as a result, the future cash flows pertaining to the debentures are solely interest and capital. On 1 January 2018, Investco Ltd paid transaction costs amounting to 150,000 to conclude the investment in the debenture of Tego Limited. The investment in debenture of Tego Limited is held within a business model whose objective is to collect contractual cash flows of interest and principal on specified debts. Investco Limited's chief financial officer is of the opinion that the debentures should be classified and measured at fair value through profit or loss, since the value of the debentures is expected to increase over time. So they are saying comment on whether they should be classified through profit or loss. Right, I'll just quickly do this so that we don't waste time on this part, please. For the sake of time, I think I've talked about this a long time. Investment in Tego Limited debentures. I'll just take this. Please, you can read it at your own time. This is where our answer is. I think we did it on number 1. I did it on this number 2. So I can just take it as it is there. So when you get a question on classification, this is your answer. Right. The purchase of the debentures result in a financial asset in the hands of what? It's no longer capital investors. It's Investco. Limited. Right. And the purchase also results in a what? In a financial liability. Right. It is a financial asset in Investco. And a financial liability in Tego. Otherwise, in exam scenarios, if there are 5 marks, please, you don't have to do this part. It will waste your time. Because normally, if there are 5 marks like that, you can just start from the second part, where the financial assets shall be classified as. You just do this part here normally if it's just 5 marks. But if you see 10 marks also, you start from the beginning. So the financial asset is a financial asset in the books of Investco. Right. If financial assets are classified based on the business model. Right. The 2 conditions is the asset should be held with a business model whose objective is to collect contractual cash flows. And we've been told here that Investco, they hold the financial asset within a business model whose objective is to collect contractual cash flows. So the first condition is met. Right. And number 2, the contractual terms should be solely principal and interest. And we're told here that the contractual terms are solely what? Interest and capital. Right. They were acquired on 1 January 2018, and they will be redeemed on 31 December 2022. So that is every 31 December, starting from 31 December 2018. up to 31 December 2022. And the principal, here we have right. So therefore, our conclusion since both conditions are met, the chief finance officer is therefore wrong. And whether the financial assets is expected to increase in value or not does not affect the classification of a financial asset. So there are two things: the business model and the contractual characteristics. Those are the two things that influence the classification. All right. Any questions there?
Eugene,
Yes.
the part that says debentures are solely interest and capital. So since they didn't say principal, the capital, does the
Capital is
capital
principal.
represent
Capital and principal are one and
growth?
the same thing.
Oh, okay.
Capital and principal is one and the same thing. Different words describing exactly the same thing.
Right, thank you.
Any other questions? So we can go to the second question. Prepare journal entries required to account for the investment in Tego Limited debentures in the accounting records of Tego for the year ended of investing. Right. First of all, remember, as long as it's at amortized cost, first of all, we have to determine what effective interest rate. As long as it's at amortized cost. Right. So we'd say our PV is equal to our fair value plus transaction costs. Right. These debentures were acquired at their fair value of 550 times 10,000 plus the transaction costs, which were 150,000. So we'd say $10,000 multiplied by 550 plus 150,000. What do we get?
$50,000.
Like this, my bro. Is it okay? Right.
Yes,
Then our
it's fine.
PMT. Remember, our PMT is calculated based on the face value. So our PMT would be 10,000 times the face value, 600 times 12%. So remember that the PMT is on the face or nominal value. What do we get?
720,000.
Our FV is the redemption value. We're told that the redeemable at face value. That means it's 600. What do we get? I think it's 6 million. Also remember our rule that the PV should have a different sign to the PMT and the FV due to the flow of money there. Right, our N, remember that please, when you determine your N, don't be confused with MAC. We don't look at the dates from the issue date of 1 January 2016. We start from when we bought those financial instruments, we as a company. They bought on 1 January 2018. And they will be redeemed on 31 December 2022, which is 5 years. So it's not 4, don't just say 22 minus 28, 2018, because this was 1 January and this is 31 December. So this is 5 years. So when you determine your N is from the date that we as a company acquired those financial instruments. All right. Then can we determine your interest there?
13.6864.
13.68.
64.
Thank you so much. Right. Always check your question. Sometimes they would at the end here, they would give instructions on the rounding off. It's only that I removed the part here. Normally they ask for these types of questions, they usually ask for 3, 4, 5 decimal places. Right. After that, then we can prepare our amortization table. So as long as it's at amortized cost, remember to find your effective interest, then you get your amortization table. Right. Right. There's also capital growth here because our PV it's 5,650,000, whilst our FV it's 6 million. Right. So then we start with 1 January 2018. Then 31 December 2018. 31 December 31 31 right. Right. Our coupon it's at 12%, which we calculated year 720. And the starting balance is 5,650. Right.
$53 to $79.
Okay. Yours will be, please guys, if you get different answers from the ones that I'm getting, don't worry. It's because you are using the accurate percentage. Your figures are the more accurate ones. Because you are using so if you get a slight differences between me and these figures, please don't be disturbed. Yours are the ones that are correct. Me, I'm using Excel. My percentage here I've rounded off. But your financial calculator will not be rounding off the percentage. It will be using the very exact percentage. So your figures are more accurate than mine. So don't worry if you see you are getting different answers. Don't even worry. It's because of the rounded, but they should not be too different. And you'd find that you guys, when you get this, it will be exactly 6 million. Maybe because of the rounding off, that's why there's that difference of 14. That's why you see they insist on 5, 6, sometimes decimal places. So don't worry, your figures will be slightly different to these ones. And you know that the ones that you're getting on the financial calculator are the accurate ones. But I will use these ones just for now. Right. Then remember that when they say journal entries, please know your year end. You don't just have to do all the years. I think the other examples I did all the years just for you to see. But today I'm only going to concentrate on the year that they told us, which is the year ended 31 December 2018. So now say, first of all, we'll do a journal entry on 1 January 2018 when we acquired the debentures. We'll debit investment Investco Ltd debentures. And when we acquire an investment, it's an asset. When we acquire an asset, our asset increases, so we debit it at that 5650. Then we credit, and we don't have to record the transaction costs. They will be absorbed in the investment. That 150. Right. Then on 31 December, the general entries, the narrations, you check if they are required. But if they are required, they're just the same as the ones that I did on the first question. Right. Then on 31 December, you do this line here. You debit your bank because we're going to receive money. And the money that we are going to get is equivalent to the coupon, which is the 720. So the coupon payment will always be your bank. Then if there's capital growth, you debit the investment. But if there's a repayment of capital, you have to credit the repayment. Remember, I told you that there's a difference if the PV is less or more than the FV. Like as long as the FV is more, then we'll be debiting the investment with the capital growth. There will be capital growth. But if the PV is more, there will be capital repayment, which will be credited to the investment. So here we'll debit, that is the first line on that date. Sorry, the capital growth is not this, is the 53. Then we credit finance income. Is this one. For every 31 December 2018, they will be doing that. And if we had the impairment, we're also going to account for the impairment. If credit risk has increased, we would use the lifetime expected credit losses and calculate it on this balance. If it had not increased, then we'd just use the 12-month expected credit loss. Any questions? No questions. Right. So then that's it on that one. They just said 2018. Then number C, prepare all journal entries required to account for the investment in Yellow Star Limited shares in the accounting records of Investco for the financial year ended 31 December. So you see, when they just say prepare, you don't have to discuss those things there. So you only discuss that thing that it is a financial asset if they ask for you to discuss, like in this one, or that other one that we did, the number 2, whereby they were saying, can you discuss if the journal entries are correct. So for you to be able to discuss that, you needed that theoretical background. That's why I was explaining it. But if they just say prepare journal entries, you just have to know on yourself which classification. You don't have to write all those things about the classification. Right, yellow limited star shares. Right, on 1 July 2018, if Investco Limited acquired 2,000 shares in Yellow Star Limited at a price of 12 rand per share, the investment in Yellow Stars Limited represents 2% of the issued shares of Yellow Star Limited. On the same day, Investco Limited paid transaction cost of 20 cents per share to acquire the shares in Yellow Star Limited. On 31 December, the market value of one Yellow Star Limited share amounted to 13.50 rand. Right. This one, it's an investment. We have to check the classification. It can, it's not at amortized cost when you invest in shares, because the payment are not necessarily solely interest and the principal. Remember, shares, you don't even know when you are going to get your money. And actually, when you sell a share, most probably you will not even be selling to the company. The company will have nothing to do with it. It will be a private transaction between you and the buyer. So it doesn't meet those two categories. So an investment in shares would either be through profit or loss or through other comprehensive income. It's an election. Right. Now, normally, if in your exam they didn't explain whether it's through profit or loss, or let me just check if they said anything on the policy there. They didn't say anything on whether it's through profit or loss or through other comprehensive income. If they don't say anything, you look at the type of company. But first of all, just check if they say something. But if they don't, you look at the type of company. Right, this company, it's an Ltd company. That means the shares are traded on the exchange. That means anytime we can sell them. So we just account for them through profit or loss. But if it was PTY Ltd, then we would say through other comprehensive income. But please, guys, hear me correctly. You only use that guideline if they didn't say it. Like in this case, if they said Investco elected to measure these shares at fair value through other comprehensive income, then that's it. You measure through other comprehensive income. So this guideline of PTY or just Ltd, you only use it if there is no guideline, if they didn't tell you the classification that the company has chosen. Right. So here, I would say, first of all, on 1 July 2018, we record the purchase. And since I've said it's through profit or loss, right. Right. We debit our investment in Yellow Star Limited shares. This is an asset to us as a company if we buy these shares. It's a financial asset to us. And it will be measured only at cost, excluding. As long as it's through profit or loss, you exclude transaction costs. So it will just be 12 multiplied by 2,000, which is 24,000. Then the transaction costs will come on their own. Will be recognized as an expense directly. So when we say you don't include them in the investment, it doesn't mean that you don't record them, but you record them separately. Right? They said 20%, 20 cents. So say 2,000 times 20 cents. I think we get 400. Then we credit the bank because we're paid, which is 24,000 plus 400, which is 24,400. That's our general entry on acquisition. Now, if these shares were classified through other comprehensive income, this transaction cost was going to be part of this. So it was going to be 12 times 2,000 plus 400. So it was going to be 24,400. And we're not going to have separately the transaction cost. So here, in this case, we have them separately because I've said we've classified these shares as at fair value through profit or loss. Right. So this will be on 1 January 2018. Then on 31 December 2018, we recognize the movement in fair value. Right, the shares have gone up in value from the 12 rand that we bought them. They are now at 13.50. Now, if shares increase, we increase our investment. So we debit the investment in Yellow Star Limited shares. That would be the difference. We would say 2,000 multiplied by 1850 minus 12. What do we get?
$3,000.
Then we credit a value gain on investments in Yellow Limited shares. Right, this one is P&L. But if those shares were through other comprehensive income, it was going to be OCI. So these are the general entries for the investment in Yellow Star. Any questions? Right. Then the last part of this question number D, calculate the balance of the expected credit losses allowance for trade receivables as at 31 December. Right. What's the trade receivables? Investco Ltd uses the simplified approach when assessing expected credit losses. At reporting date, Investco Ltd's trade receivables amounted to 6.6. Trade receivables do not include a significant financing component. So we've got those trade receivables. Then we're told that based on past experience adjusted for forward-looking estimates, Investco Ltd expects that over the expected lifetime of the trade receivables, the default rate of the trade receivables will be as follows. So they will simply say, they will just take this percent and multiply by the current debtors. The 0.5 by those with 30 days, the 1% by those with 60 days. Remember, we're given here that the current are these ones, 30 and 60, like that. So we'd say our D calculation of allowance for credit losses. Right. So would say 0.2 current would say 0.2%. Please, guys, when you punch that, remember that this is not 2%, it's 0.2% times 3.6. What do you get?
$7,200.
Like this.
Yeah, it's 7.
Am I correct now?
$7,200.
17.
That's correct.
You're
7.2.
correct.
Okay, thank you. Right. Then the next one would say 0.5% multiplied by 1.8.
$9,000.
Then there's 60 days. $1 multiplied by 1.2.
It's 12,000.
So this is about a allowance for credit losses. Any questions?
Eugene, can I just ask, in terms of shares, do we always have to count? Do we always have like a fair value gain or fair value loss? Does that only appear on shares?
It can also appear on debentures. Remember, debentures, it's possible that they might not be at amortized cost. For example,
Oh,
if you buy debentures which are compulsorily convertible to shares, they cannot be classified at amortized cost. It's just that for this module, they've never examined on such debentures. So you'd find that for this module, usually debentures, it's at amortized cost. Then the shares, they're either fair value through profit or loss or fair value through other comprehensive income. But they are debentures. I think those who are going to do CTA modules, they will be able to learn about debentures that can be at fair value through profit or loss.
okay. So in this module, it doesn't actually concern debentures on fair value.
Yeah, I've never seen them examining, but they are written in theory, but examining them so far, they've never.
All right. Thank you.
That's why we mentioned that only. Right. Any other questions? Right. If we don't have any questions, my time here, it's 3:30. I'm going to give you a break up to 4:45. So we'll resume at 4:45 and we'll end anytime from 4:30 to 5:00. So I'm giving you 15 minutes, the same link, and I'm not cutting the meeting. So if you are not going out, remember to mute yourself. Otherwise, we'll hear your stories there. So remind me to resume the recording when we start. Okay, thank you. We can rest for 15 minutes. Welcome to our class. As we continue from where we left off, right? From the time that I started financial instruments, I've been dealing with the financial assets. Remember, we said that the instrument will be a financial asset in one company, whilst it's equity or a financial liability of another, right? So in this case, we're only dealing with financial assets. So now I want to change and look at financial liabilities now. Right, let me just check. Right. I would also like to, before I proceed with these questions, I would like to explain a few things. All right. If a company issues a financial liability, and remember we defined what a financial liability is. It is a contractual obligation to deliver cash or other assets at conditions that are unfavorable to you. Right. I will talk about preference shares. Preference shares, if they are not redeemable, they are equity. If they are not redeemable, they are equity. And if they are redeemable, it depends on who holds that right to the conversion. Normally, when redeemable preference shares are issued, they will state that maybe either the company issuing decides whether to convert to redeem them or not, or the option would be to on the holder of the shares, or they can be compulsorily redeemable. They can be compulsorily redeemable. Right. So if shares are compulsorily redeemable, or the option to redeem is with the holder of the shares, then such shares are liabilities. But if the option to redeem is with the company, then they are equity, because the company will redeem them at their own time. So they will be equity. Right. Then, when you issue debentures or when you get a loan, that's a financial liability. Debentures and these loans are accounted for at amortized cost, the same way that we were doing when we were dealing with the financial asset at amortized cost. The difference is that this time around now, if there are any transaction costs, instead of adding them, they will be subtracted. Right. So now let me see. I think we need number 4. Let me see if there's another one. Right. Okay, at your own time, can you also do number 5? At your own time, can you do number 5? It's the same as what we did, what we've been doing all along. Just a second, I'm looking for something. No, let me just do this one. Question 4. Right. A Performance Limited issued 30,000 10% compulsory convertible debentures on 1 March 2020 at their face value of 100 rand each. interest on the debentures is payable annually on 28 February. The debentures are convertible at the option of the debenture holder into ordinary shares at 1 ordinary share for every 5 debentures held on 28 February 2022. When the debentures were issued, the prevailing market interest rate on similar debentures without a conversion option was 12% per annum. Right. So now, this is a financial liability because it gives a contractual obligation to Performance Limited to pay interest annually and also to repay the principal at the end of the loan term. Right. Not only a financial liability. Right. Let me just say question 4 here. Convertible debentures. Right. What are convertible? Before I answer the question, I want to explain a few things here. What are convertible debentures? These are debentures that may be converted into ordinary shares in future. So that means either the company or the holders of the debentures, you have the option to convert the debentures into shares. So these are a compound financial instrument. What is a compound financial instrument? This is an instrument with dual characteristics. Right. Number one, there is a financial liability. In the form of interest that should be paid annually. And the principal repayment on maturity if holder decides to get cash. What happens normally with these convertible debentures? At maturity, the one with the option, in this case, the holder, will decide whether they want cash or they want their debentures to be converted into shares. So in this case, on 28 February 2022, 28 February 2022, we are told that the option is with the holder. Those ones who are going to buy these debentures, they will decide whether they want their money back or they want what? Their debentures to be converted into shares. So that's a obligation to pay interest annually, and on 28 February 2022 to repay the amount if these guys decide opt for cash. That is a liability. Right. Then there is also an equity component. If the holders decide to convert their debentures into shares. So that means when you buy those debentures, you are buying two things: the liability and the equity component. So as a result, the company, according to IFRS 9, you have to recognize the liability component and the equity component. Right. Then first of all, just like the financial asset at amortized cost, we have to determine effective interest rate. No, the effective interest will use the prevailing market rate. Sorry. Right. The prevailing market interest rate for similar debentures without a conversion option. Without, because exams or assessments they can give you with a conversion option and without. We use the one without a conversion option. Will be used as the effective interest. Right. So we're saying in this particular case, we have the issued 30,000, a convertible at face value, and we were told that the debentures are convertible at the option of the holder into one for every 5, right? You will have to use the face value, or if they can tell you that maybe they are redeemable at 105, you will have to use what the 105. So that will be the future value. So the future value is the redemption value. So we'd say the FV is equal to the redemption amount. It can have a discount. That means on maturity. If they didn't tell us about the discount or premium, you assume that is the par value. So that's 30,000 multiplied by 100, which is equal to 3 million. Then our PMT is annual interest. Which is equal to, we're told that the interest is 10%. Multiplied by 3 million. And number of years from issue to maturity. They were issued on 1 March 2020, and they'll be converted on 20th February 2022, which is 2 years. Prevailing market rates for similar debentures without a conversion option. At issue date. So you should be very careful. In some of your assessments, they can give you the prevailing market rates for those that have with a conversion option and without. We use the without. And number 2, you would find that they can also give you the prevailing rate at acquisition, and they can give you the prevailing rate on another date that you are reporting. We use the one at the the prevailing rate at the date of issue. The prevailing rate for those debentures without a conversion option at issue date. Right. So here we're told that it was 12%. 12%. Then you get your PV. What do you get as your PV?
$2,898,596.
596. So that means we'll now say the total proceeds are 3 million. And the liability component, the present value is the liability component of the convertible debentures. Right. Then the equity component. The difference. So we're saying of the 3 million that we received, 2,800,000 is a liability and 101 is equity.
Eugene, I'm getting a different answer for the first one. Am I? I don't
What
know
are
what
you
I'm
getting?
doing. 1,884,000.
That one is way far away. Which calculator are you using?
The sharp EL.
Can you
Okay,
clear and see?
I'll correct myself. I'll rectify it.
You'll be able to get it. Please check things like is it at beginning or end? And you also check if the payments per year should be 1.
Okay.
If it's sorted, you can just quickly do it. You start with your number 3 million, that's your FV, 300,000, that's your PMT, 2, that's your N, then 12, that's your I, then you get your PV.
Okay, thank you. It's sorted. Thank you so much.
Okay, thank you so much. Right. Now we then do the amortization table. Right. We'll have my debt. %, effective interest, at 12%. Gross balance. Right. So we have 1 March 2020. 28 February 2021. 28 February 2022. That's the redemption date. We start with 2898,596. Right, there's also capital growth because the FV it's 3 million, remember, and it's more than the PV. Right. Then we have 300,000 is our coupon. It's here, the PMT here. Right, then you can use your financial calculator. Right, so that's it. Right, now our journal entries. They only want a 2021. So the other, I'll tell you, let me just mention that, I'll mention that they required here so that you know what to do there. Remember that our year ended 28 February 2021, which we want starts on 1 March. The date that we bought the debenture. So it's 1 March 2020. We'll have our we'll debit our bank because we're receiving money. Now, when you issue debentures, you receive money on the date of issue. 3 million, sorry, we'll receive the 3 million. Then we'll credit liability component of debentures, which will be this one, the present value that we got there. Then we'll credit equity component, which is equal to this one here. Right. Issue of recognition of issue convertible debentures. Right. Then on 28 February 2021, then we now pay. There will be finance cost, which is the effective interest. This one here. So your finance cost, you get it under this column of effective interest. So it's this one, not this one. It's this one. The effective interest is your finance cost. Then we credit our bank. Remember that we only paid 300,000. Then we credit equity component, so the liability component. Of convertible. You should note that this can also be debited, the liability component. If our PV was more than the FV, then this could have been a repayment of the liability. So this one was going to be a debit. So whenever our PV is more than FV, the liability component will be debited, S will be repaying. Right, then we do a same journal entry on 2022. Right, what I'm doing now is not required. So the answer is what I've done so far. So this one, so that I'm doing it so that you know where to end defend the exam. If they say 2021, then we're done. So here I'm now doing 2022. Right, our finance cost will be this one here now. Our bank does not change. We're just paying 300,000 every year. Then our liability component will be this one here. So this, maybe let me also recognizing effective interest payment and capital growth. Then on that date, remember 28 February 2022, that's when the holder of the debentures will decide whether to get cash or get shares. Right. If the holder of the shares decide to get cash, will now debit liability component. Right. Of convertible debentures. Which will be 3 million. And we credit bank. Right. Then, so if the holder, that means repayments or recognition of debentures redemption. Right. Then we will have our, if the holder decides to convert the debentures into shares. Instead of bank, will not pay. It will be share capital now. So that's how we record whether they decide to convert. And you should remember that the original equity component remains in the books. This one here, this 101, it will remain in the books. It can just be moved from one element to another, maybe to retain earnings or stuff like that, but it will not be removed on maturity of the debentures. Any questions? Right, and also,
Sir, can you go to the last journal, please? Thank you.
if you are worrying about this document, I will send to you this document, don't worry. Right, so here, another thing, this FV, you only include it if redemption is at the option of the holder. Otherwise, if the option is with the company, there are two other differences. The option can be with the company, or the shares can be automatically converted. Now, as long as they are automatically converted, or the option is with the company, then in that case, the FV is not included. We don't include the FV in that case. Any questions? No questions. Right, let me just see if there's any difference, but if they are not different, then I will list you. Let me just check. Number 5, I said you can do it on your own. Right. Right, I will do number 8. After doing number 8, you can also do number 7 using what I would have done in number 8. Right, they said Smooth Care Limited is a producer of personal body care products and there's a 30 September year end. The following transactions took place during a financial year ended 30 September. Right. Then we were told that here, discuss in terms of IS 32, financial instruments, presentation, the correct classification, and initial measurement of the convertible debentures. Your discussion must include relevant calculations. Right. Right. Just a second. Right. Right, the first part. Classification. And initial measurement. Convertible debentures. Right, my friends. Actually, our answer is here. When I explained that these are compound financial instruments, that's where our answer, I'll just do it more comprehensively here. Right, whatever I'm writing, my friends, it also applies if we're dealing with the convertible preference shares. It's the same interpretation also for convertible preference shares. Right, the debentures are a financial instrument as they give rise a financial asset in the hands of the holders. And a financial liability or equity in the hands of this company, which is Smoothcare Limited. Right, that's number one there. Right, right. So we're saying here, there is a liability in the form of interest of at 9% that is to be paid annually. We have an obligation as Smoothcare to pay that interest. Right. So we can say interest at 9% per annum creates a financial liability for Smoothcare. As it is a contractual obligation to deliver cash. Right. Then the potential redemption of the debentures does not create a liability, as the redemption is at the option of Smoothcare. But if we're doing the previous question, remember that the option was in the hands of the holders. So we're going to say that it was going to create the potential redemption was going to create a what? A liability. So we're going to say it was going to create a liability. But in this case, since they said here that a smooth K is the one who decide, so the principal does not create a liability. They said what the debentures are converted at the option of smooth K. So there's no liability of the principal amount. But if they said it's at the option of the holder, then there was also going to be a liability. Right. Then the potential conversion of the debentures into equity at maturity creates an equity component. So there's an equity component there that arises from the conclusion, from the conversion. Right. Right. I'm talking about classification here, because they asked the two things and initial measurement. This is a compound financial instrument with both characteristics of equity and a financial liability. Right. Then initial measurement. Right. So then we would say, I want you to follow me here and see the differences between this one and the previous one. Right. Since the option to redeem is at the option of smooth K, our FV, my friends, will be 0. If they say the debentures or preference shares are convertible at the option of the company, your FV will be 0. Or if they say they are compulsorily redeemable, your FV will be 0. Right. Then our PMT. But if they say it's at the option of the holder, like in the previous question, then we'll have you will have your FV. Right. Then our PMT, we know that these are 2.5. And they have a fair value or a face value of 1,000. We use the face value, then interest is 9%. So it's 2.5 times 1,000 times 9%. What do we get?
225,000.
Right. Our N, we know that these debentures were issued on 1 October 2017, and they can be converted on 30 September 2022, which is 5 years. Right. Then interest, that's the interest on similar debentures without a conversion option. A market-related interest rate for similar debentures without a conversion option is 11.5%. Right. Then we'll have our what? Our PV. What do we get?
$821,223.
Right. So then we have our proceeds, which is 2.5 times 1,000, which is 2.5 million. Then our liability component. Of convertible debentures. Then we have our equity component. Right. Then we do our amortization table. So please, can you see that difference? We don't include the FV if the option is with the company or the shares are compulsorily redeemable. So you should know that. Okay, then we leave this. Here I don't have growth. I simply have the repayment of capital. Why? As you can see, the FV is less than the PV. So there's no growth. So we have 1 October 2017, 30 September 2018, 30, 30. Right. Right. So we start with 821, 223. I think I forgot also when I did the other question to oh, I did. Okay. That's our PMT. Our effective interest. Capital. Balance. Right, that's our amortization table. Right, our required, it wants us to do journal entries for the year ended 30 September 2018. I'm not going to do the narrations, they're the same as above, although they are required here. All right, so we first do October. Oh, sorry. Before I'm now on the next one now. Remember, I've not answered this. Can I please finish answering that other one before I go to this one? Well, I was answering the initial measurement. So I say it initial measurement. Uh, 821, 223 will be accounted for as a liability component. Of the debentures. And 1,678,77 will be accounted for as equity components. So that's the first part. That will be the end of that first part. Then this amortization table and stuff like that will now come now when we do this, the general entries now. They said year ended 3rd September 2018. Right, so then we'll now do the general entries here. Right. On October 2017. Right, we would start with the what? Bank, the amount received in the bank account, which would be 2.5 multiplied by 1,000. Then we'll have our liability component of convertible debentures. This one here. Right, then we will have equity component. Which is this one here. Then on 30 September 2018, we'll debit our finance costs. The effective interest. Then we debit liability components. Of convertible. Remember, this time around, it's a repayment. So I want you to see the difference between when there is a capital growth and when there is capital repayment or reduction. Like here, our FV is 0, which is less than the PV. If you still remember in the previous question, we're crediting the liability component because it was growing. But in this case, it's being settled. So when your FV is less, instead we'll be debiting as we'll be settling the liability as we go. Then we credit bank, which is the 225,000. That's our answer. Any questions?
Eugene, I have a question. Can you please just scroll up?
You want me to stop?
Yes, you can stop. So with regards to the last two sentences, the potential redemption regarding the equity and liability, how did you come about that the redemption or for the debentures does not create a liability. That's what I don't understand.
That last part, can you read the last part? What does it say?
The potential redemption of the debentures does not create a liability, as the redemption is at the option of smooth care.
Yes.
But
That's,
I
that's
don't
the reason.
understand that. So because it's in the hands of smooth care, it's not a liability.
Yes, because they will do what they want. There's no obligation. It's up to them to pay money or not.
Oh, okay. Okay.
If they
So
decide to
because they are
convert
the
into
ones
shares, they will
deciding,
not pay money.
they will just give shares.
Yes. So it's no
So
longer a
that's why.
liability.
All
Uh-huh.
right. Okay.
So it
Thank
will be
you.
liability like in the previous example. Let me go back so that you can see the previous example. Like the previous example, it was a liability because, can you
It was
see
in
here?
the option of the
Yeah,
buyer.
at the option of the debenture holder. So in that
Okay.
case, the repayment, the redemption will be a liability.
The
That's why the
liability.
FV, we included it there. But in this case,
Okay.
that's the reason why we didn't include the FV, because there's no obligation per se.
Okay. Thank you.
Right. So that's it on that one. And the last question for the day is part C. Present the effects of the investment in Shower Fresh Limited in the extracts. So they can also ask you to do this. And please, can you go in your books and try to do the disclosures? You can just take the examples and then you try to do the disclosures. But maybe I will find one time that I can do it. But maybe I'll find a question, then I'll do, then I can just send to you in the groups. Right. My friends, they are talking about shares in shower. They want us to present this information in the statement of financial position and statement of profit or loss. Right, they said on 1 December 2017, Smooth Care Limited purchased 1,500 shares, representing a 5% interest in Shower Fresh Limited for 36,000. On the same date, Smooth Care Limited incurred and paid transaction costs of 2,500 on this transaction. On 31 July 2018, Smooth Care Limited purchased an additional 3,000 10% interest shares in Shower Fresh Limited at their market price of 26 Rand 50 per share. A Smooth Care Limited incurred and paid transaction cost of 4,800 on this transaction on 31 July 2018. Shower Fresh Limited shares were trading at 28 Rand per share on 30 September 2018. The investment in Shower Fresh Limited was irrevocably designated as measured at fair value through other comprehensive income. So they've decided, so you can see here, although it's LTD, but these guys have decided that they've classified it as at fair value through other comprehensive income. Right. So let me do the extracts quickly. I will not take time on this one. Right. Right. No, not investment. Let me just say extracts. The statement of financial position as at 30 September 2018. Right. There are two things that will come from that investment. Number one, under assets, under non-current assets, would record the investment. right? If we've elected to measure it at fair value through profit or loss, it will be included under current assets. If we've elected to measure it through profit or loss, it will be shown under current assets. If we elect to measure through other comprehensive income, it will be under non-current assets. Then if it's at amortized cost, there will be current and non-current. Let me just go back. Like here, if it's at amortized cost, like this one here, this one, right? Like when we're in the year ended 2018, this one was growing. I think we have to talk about the one that they are paying. And one, let me check one which is not growing. Because when it's growing, all of it, if it's growing, all of it will be non-current liability. And then non-current asset, for example, then. Right, like this one, amortized cost. This 16 will be current. Like when we're when we're on 30 September 2019, the 17 for 2020 will be current. And this one will be non-current for the amortized cost. So amortized cost results in current and non-current. Unless if there's capital growth, the whole amount will be non-current as long as the redemption will take place after a year. Right. But if it's at fair value, if it's other comprehensive income, then we include them under non-current assets. So then we'll have an investment in equity instruments. And these shares will be included at the fair value on that reporting date. Right, on 30 September 2018, the fair value was now 28. Remember, we've got 1,500 plus 3,000 shares. So we'd say $1,500 plus 3,000 multiplied by the cost, which is the value, which is 28. What do we get?
126,000.
Right. So you include them at the closing share price, whether it has gone up or gone down, as long as we are measuring them at fair value. You include them at the closing price. Right. Then under equity, we'll have the mark to market, which is the increase in the value, which is 126,000 minus the cost. Right. Remember that these ones, they were bought at different prices, and we don't and would also include transaction costs. Remember, we include transaction costs if they are measured at fair value through other comprehensive income. But if they were measured at other at fair value through profit or loss, we're not going to include the transaction costs. So these ones were at 1.5. They were bought at 36,000 with transaction cost of 2.5. These ones were bought at 2650 and transaction cost of 4.8. Right. So we'd say would say 1 minus 36,000 minus 2,500 minus 3,000 times 2650 minus 4,800. So we're subtracting the cost and all the transaction costs. They will be included there in the cost. What do we get?
Get 74,700. Someone please confirm.
Can I assume that is correct?
Minus 36,000. Minus 2.5.
Whilst they are confirming, let me also conclude the other part. So this one, that one was the part, the first part. Then they also said extract of statement, profit or loss. And other comprehensive income. We'll have under other comprehensive income. Fair value gain. Financial assets. We can just say on financial assets, it's fine. That's it.
It's 3,200, Eugene. Sorry. Please correct.
3,000.
200. 3,200, Eugene.
3,000.
32.
3,032.
It's 3,200. The top one.
It's the same figure.
Okay.
Right. Any questions?
Eugene,
All right. And if we don't have any questions, then we can enjoy our short weekend. Thank you so much. God bless you richly. And thank
sorry,
you.
Eugene.
Yes.
I wanted to ask regarding the mark to market. I didn't get the part when you were explaining. I think you said it's an increase in something.
Yes. When our shares that are held through other comprehensive income, if they increase in value, then that's the
Okay.
mark to market.
Okay, thank you.
Thank you so much. Enjoy your day.